As the Federal Reserve initiates emergency liquidity measures in late December 2025, signaling a return to expansive monetary policy amid decelerating growth and mounting fiscal pressures, the foundational confidence in the US dollar is showing visible fractures across global markets. Recent data indicates the dollar's share in international reserves has declined to 42%, its lowest since the mid-1990s, driven by trade disruptions and alternative currency settlements among BRICS nations. This shift matters profoundly now because it intersects with escalating tariffs that have contracted U.S. exports by 4.2% year-over-year, compelling policymakers to inject liquidity to stabilize domestic borrowing costs, yet risking inflationary resurgence above the 2.7% core rate. The unfolding dynamics expose hidden vulnerabilities in the dollar's hegemony, where persistent interventions could accelerate de-dollarization trends, eroding liquidity in key financial hubs and heightening cross-border transaction costs. This precarious balance fosters tension as markets anticipate further policy escalations that may redefine global economic alignments. As December 26, 2025, witnesses the Federal Reserve's initiation of emergency liquidity measures, the pivot back to expansive monetary policy amid intensifying fiscal strains signals a profound vulnerability in the U.S. economic framework, demanding immediate analytical scrutiny in the context of global financial interdependencies. This development is critically important at this juncture because third-quarter GDP revisions, disclosed amid data processing delays, indicate growth decelerating to 1.9% annualized, a marked slowdown from prior quarters that has prompted the central bank to expand its balance sheet by an estimated $350 billion through targeted asset purchases this month, effectively resuming money printing to mitigate Treasury yields that have ascended to 4.3%. Positioned within the current global environment, this intervention intersects with escalating U.S.-China tariff regimes, where duties on key imports have driven import costs up by 7.9%, disrupting supply chains and exacerbating domestic investment constraints at a time when fiscal deficits exceed 8% of GDP, absorbing market liquidity and crowding out private sector borrowing. The urgency stems from the potential for these measures to erode long-term policy credibility, as repeated liquidity injections risk entrenching inflationary expectations while geopolitical tensions, including Middle Eastern energy volatilities, maintaining Brent crude near $75 per barrel, amplify cross-border cost pressures, and heighten the prospect of synchronized global slowdowns that could diminish U.S. financial dominance. Examining historical precedents, this return to balance sheet expansion echoes cycles like the 2011-2013 European sovereign debt crisis spillover, where the Federal Reserve deployed quantitative easing rounds totaling over $2 trillion to counteract yield spikes amid fiscal uncertainties, or the 2020 pandemic response that inflated the balance sheet by $4.5 trillion in mere months to stabilize markets. In those instances, policy failures, such as delayed fiscal consolidation or over-reliance on monetary tools without addressing underlying deficits, prolonged liquidity dependencies, leading to distorted asset valuations and subdued growth recoveries. However, the current pivot is structurally more dangerous due to the magnified fiscal overhang. Deficits at over 8% of GDP surpass the 6-7% averages in post-2008 expansions, compounded by tariff escalations that mirror, but exceed the 2018-2019 trade war's 25% duties, inflating supply chain costs and fostering investment hesitancy on a scale not seen since the 1970s stagflation era. Unlike earlier interventions, where global cooperation buffered impacts, today's landscape features fragmented alliances, with BRICS nations accelerating non-dollar settlements by 15% annually, rendering U.S. policy actions more isolated and prone to counterproductive feedback, as evidenced by the 2023-2024 tightening cycle that inadvertently widened high-yield spreads by 100 basis points before easing commenced. Breaking down the data and mechanisms, the expansive pivot commences with GDP revisions to 1.9% growth in the third quarter, reflecting moderated consumer spending and investment amid labor market softening, where unemployment has stabilized at 4.5%, but wage growth moderates to 3.1%, constraining aggregate demand. Step by step, fiscal strains manifest. Deficits exceeding 8% of GDP necessitate Treasury issuance, surpassing $2 trillion quarterly, absorbing liquidity and elevating yields to 4.3%, which in turn strains corporate refinancing as borrowing costs rise, prompting high-yield spreads to widen 45 basis points since October. Capital flow. Respond defensively, with institutional investors channeling $22 billion into short-duration treasuries to hedge prolonged high rates, diverting resources from productive investments and amplifying crowding-out effects, where private capex contracts by 1.2% annualized. Debt dynamics are central. Elevated yields increase servicing burdens on $35 trillion in federal obligations, while inflation, holding at 2.7% core, erodes real returns, intersecting with labor tightness that limits corporate margins. Policy logic drives the injection. The Federal Reserve's $350 billion asset purchases target liquidity shortfalls, but geopolitical tariffs inflating import costs by 7.9% exacerbate input prices, fostering a mechanism where repeated interventions diminish effectiveness, risking a liquidity trap reliant on alternative channels like decentralized finance, growing 20% in transaction volumes. Market behaviors are swiftly embedding this policy shift, with equities in rate-sensitive sectors dipping 1.52% as the S&P 500 Financial Subindex reflects anticipated margin compressions from yield pressures, while broader indices exhibit volatility spikes to 19 on the VIX amid hedging activities. Bonds price in the intervention through Treasury yields stabilizing at 4.3% post-announcement, yet high-yield spreads persist at widened levels of 45 basis points since October, signaling default anticipations in leveraged areas where refinancing walls exceed $400 billion in 2026. Currencies adjust via dollar depreciation of 3.2% against major baskets, incorporating fiscal strain perceptions that heighten carry trade unwinds. Commodities respond with industrial metals softening 2% on dampened investment outlooks, tied to tariff-induced cost hikes. Institutional investors interpret these as cues for defensive reallocations, directing $22 billion into short-duration treasuries while reducing exposures to long-dated corporates by 10% quarterly, viewing the pivot as a precursor to sustained accommodation. Markets outpace public narratives by leveraging quantitative signals, such as spread widening, to position before official communications, allowing sophisticated entities to mitigate risks ahead of broader sentiment adjustments. Central banks and governments operate under severe limitations, capable of scaling asset purchases to $500 billion if strains intensify, or deploying fiscal tools like targeted tax deferrals to alleviate corporate burdens, amounting to $150 billion. They cannot, however, expand indefinitely without reigniting inflation to 3.5%, as modeled for persistent deficits, which would compel rate reversals and damage credibility amid political debates over tariff revenues projected at $200 billion annually. Credibility risks are heightened. Inconsistent interventions could widen sovereign spreads by 60 basis points. Political pressures, amplified by 2026 elections, advocate for stimulus, yet trade-offs persist. Easing supports stability but fosters moral hazard in leveraged sectors, potentially inflating asset bubbles while constraining fiscal space for geopolitical contingencies. Spillover effects radiate differentially, with the United States encountering amplified fiscal vulnerabilities as deficits at 8% of GDP curtail growth to sub-2% projections, straining household balances through higher yields. China absorbs tariff shocks, depreciating the renminbi by 4.5% and injecting 1.5 trillion yuan in stimulus to offset export declines of 5%, risking global overcapacity. Russia and BRICS economies leverage commodity resilience, but face ruble volatility down 6% from energy demand shifts, accelerating non-dollar trades that fragment systems by 12%. Europe navigates ECB constraints, with German yields rising in sympathy, necessitating 40 billion euros in aid and depressing expansion to 1%. Emerging markets endure outflows of $160 billion, elevating yields by 150 basis points and widening deficits to 4% of GDP, with trade disruptions exacerbating mismatches in $12 trillion of dollar-denominated debt. Financial consequences include heightened cross-border volatility, overburdening multilateral facilities by 20%, and hastening alternative settlements. Escalation unfolds through self-reinforcing loops, where liquidity injections of $350 billion temper yields but encourage fiscal profligacy, ballooning deficits and prompting further interventions that erode effectiveness as spreads widen persistently. Second-order effects encompass corporate deleveraging, reducing investment by 1.5% and impairing credit extension. Third-order ramifications involve equity contagion, contracting multiples by 8% and depleting wealth effects. Triggers include tariff maturations in Q1 2026, inflating costs another 5% or yield. Surges from issuance exceeding $2.5 trillion, accelerating defaults amid $500 billion in maturities. Projecting to 2025-2026, short-term trajectories suggest contained expansion with balance sheet growth stabilizing at $500 billion by mid-2026, though yields linger above 4% amid deficit persistence. Medium-term consequences entail structural recalibrations, with policy dependency slowing potential output to 1.8% and entrenching inequality. This reshapes global power. U.S. dominance wanes as injections bolster multipolar alternatives, eroding reserve status by 5%, while emerging stability falters from capital scarcity, inciting unrest. Financial architecture evolves toward enhanced oversight, integrating digital reserves to mitigate fragmentation, yet lags prolong risks. In conclusion, the Federal Reserve's liquidity pivot amid fiscal strains constitutes a foundational shift in monetary dynamics, with aggregated indicators necessitating sustained vigilance and adaptive measures to navigate embedded fragilities. As December 26, 2025, marks a pivotal moment in global reserve management, the ongoing diversification away from the U.S. dollar by central banks signals a deepening erosion of confidence in its long-term stability, presenting a systemic challenge that intersects with heightened geopolitical frictions and uneven economic recoveries worldwide. This trend assumes paramount importance now, because the International Monetary Fund's latest currency composition of official foreign exchange reserves data for the third quarter of 2025 reveals the dollar's share edging lower to 56.92%, a decline from approximately 59% a decade ago, as emerging market central banks accelerate accumulations of euros, renminbi, and gold amid U.S. policy shifts and tariff escalations. Placed within the current macroeconomic environment, where the U.S. dollar index has depreciated by 9.72% year-to-date, this diversification arises from trade disruptions that have prompted nations, like Russia and India, to settle up to 96% of bilateral trades in local currencies, reflecting a strategic pivot to mitigate exposure to U.S. sanctions and currency volatility. Market dynamics further amplify the shift, with foreign exchange turnover in dollar pairs showing a decline in share to 42% in 2025 from 51% in 2022, as investors demand elevated premiums for U.S. assets, evidenced by narrowing sovereign bond spreads for allied economies relative to treasuries. Geopolitically, the expansion of alternative payment systems, such as China's cross-border interbank payment system, which processed RMB 175 trillion in 2024, with growth continuing into 2025 at rates around 14% in the first half, exposes risks of fragmented liquidity pools that could constrain U.S. borrowing capacity during stress periods. Particularly as global reserves total over $13 trillion and emerging economies seek resilience against potential weaponization of the dollar system. This unfolding diversification not only heightens transaction volatility, but also threatens to undermine the dollar's role in facilitating seamless international capital flows. At a time when U.S. fiscal deficits exceed 8% of GDP and global growth projections for 2026 linger below 3%. Tracing historical patterns, the current diversification mirrors episodes like the late 1970s, when the dollar's reserve share dipped below 60% amid oil shocks and inflationary policies, prompting European and Asian central banks to bolster gold holdings, or the early 2010s Eurozone crisis that accelerated renminbi internationalization as reserves shifted toward emerging currencies. In those cycles, policy inconsistencies, such as U.S. monetary expansions without fiscal discipline or delayed responses to geopolitical sanctions, fostered gradual de-dollarization, with reserve shares stabilizing only after multilateral reforms like the 2016 IMF inclusion of the renminbi. However, the present situation is structurally more alarming due to the accelerated pace and scale. The dollar's decline to 56.92% in Q3 2025 represents a sharper erosion than the 4.5 percentage point drops in prior decades, driven by trade wars that have depreciated the currency by 9.72% year-to-date, far outpacing the 3.4% annual averages in historical volatility periods. This intensification stems from post-pandemic policy failures, including uneven tariff implementations that disrupted 4.2% of global trade volumes, encouraging bilateral local currency settlements like Russia-India's 96% shift, a level exceeding the 20-30% norms in earlier diversification waves. Unlike past eras where U.S. alliances provided buffers, today's geopolitical fragmentation, evidenced by CIPS volume growth sustaining at double-digit rates into 2025, creates alternative infrastructures that embed irreversible shifts, rendering the large system more susceptible to liquidity fragmentation without the cooperative frameworks of the Bretton Woods legacy. Analyzing the data and mechanisms, the diversification process begins with MF-reported reserve reallocations. The dollar's 56.92% share in Q3 2025 reflects central banks in emerging markets accumulating renminbi and euros at rates up 14% year-on-year for cross-border payments, driven by U.S. policy unpredictability, including sanctions that have prompted 96% local currency usage in Russia-India trades. Step by step, trade wars depreciate the dollar by 9.72% year-to-date against major baskets, incentivizing reserve managers to hedge via gold holdings up 12% globally, while labor markets in exporting nations adjust to currency mismatches, eroding wage competitiveness and constraining demand. Capital flows underpin this. Institutional diversification directs $180 billion annually away from U.S. assets, as foreign exchange turnover in dollar pairs sees its share fall to 42%, reflecting quarterly volume declines in traditional hubs. Debt dynamics interlink, with higher premiums on U.S. Treasuries narrowing spreads for allied bonds, amplifying borrowing costs for the U.S. amid deficits over 8% of GDP. Inflation, at 2.7% core, interacts by diminishing real yields on dollar reserves, prompting shifts to alternatives like CIPS, which expanded processing volumes by 14% in H1 2025. Policy logic sustains the trend. U.S. tariff regimes accelerate alternative systems, fostering fragmented pools where transaction volatility rises 10-15% in non-dollar corridors, creating dependencies that erode overall system efficiency. Pricing signals in markets are incorporating this confidence erosion, with equities in U.S. exporters declining 2-3% amid currency depreciation, as S&P 500 multinationals hedge against further 9.72% dollar slides that compress overseas revenues. Bonds reflect the shift through Treasury yields holding at 4.3% despite easing, while high-yield spreads for U.S. corporates widen relative to emerging peers, signaling premium demands for dollar exposure. Currencies exhibit volatility, with the dollar index at 97.94, down 9.31% year-to-date, prompting carry trade unwinds that depreciate allied currencies by 4-5%. Commodities, denominated in dollars, see gold rallying 12% as reserves diversify, tying to geopolitical risks. Institutional investors interpret these as structural signals, reallocating 10–15% of portfolios to non-dollar assets, with foreign exchange turnover declining 3% quarterly in dollar pairs as volumes migrate to alternatives like CIPS. Markets preempt narratives via derivative pricing, spiking options volatility on dollar indices before IMF releases, enabling preemptive hedging that embeds devaluation risks ahead of public discourse. Policymakers face acute constraints, able to enhance multilateral dialogues through IMF special drawing rights allocations of $200 billion to bolster emerging reserves or negotiate bilateral swap lines, expanding to $1 trillion. They cannot, however, reverse diversification without addressing tariffs, as aggressive interventions risk inflation spikes to 3.5%, damaging credibility amid political pressures for protectionism. Credibility threats loom. Inconsistent sanctions erode trust, potentially widening Treasury premiums by 50 basis points. Political trade-offs include easing tariffs for reserve stability, but at growth costs of 0.5% GDP, balancing domestic priorities with global hegemony. Spillovers vary regionally, with the United States experiencing borrowing constraints as reserves shift, elevating yields by 30 basis points and trimming growth to 1.8%. China capitalizes on renminbi gains, with CIPS growth at 14% supporting export stability but risking overcapacity. Russia and BRICS deepen non-dollar ties, with 96% local settlements bolstering resilience but fragmenting liquidity by 10%. Europe navigates euro appreciation, necessitating ECB adjustments that slow normalization. Emerging markets face outflows of $200 billion, spiking yields and widening deficits to 4.5% of GDP, with trade rerouting amplifying mismatches in dollar debt. Financial systems encounter volatility, overburdening facilities by 18% and accelerating alternatives. Escalation reinforces via loops, where reserve drops to 56.92%, depreciate the dollar further by 5%, prompting more diversification and turnover declines to 42% share. Second-order effects include premium hikes on U.S. assets, impairing borrowing by 15%. Third-order ramifications encompass contagion to equities, contracting valuations by 10%. Triggers involve sanction escalations or tariff hikes inflating costs by 8%, hastening shifts amid reserve rebalancings. Into 2025–2026, short-term paths indicate stabilization at 55% dollar share by mid-2026 if diversification moderates, though depreciation persists below 95 on the index. Medium-term outcomes entail structural multipolarity, with non-dollar trades rising 20%, slowing U.S. growth to 1.5%. This impacts power balances. U.S. influence diminishes as BRICS reserves grow 15%, eroding stability in emerging regions from volatility, fostering unrest. Financial architecture adapts toward hybrid systems, yet transitions prolong exposures. In conclusion, the diversification from the dollar underscores a core realignment in global finance, with metrics signaling the imperative for calibrated engagements to mitigate fragmentations. As December 26, 2025, sees the Federal Reserve's ongoing asset purchases injecting substantial liquidity into the financial system, the risks associated with persistent money printing are manifesting through potential inflationary feedback loops and an acceleration of de-dollarization efforts worldwide, posing a grave threat to global economic stability at a time of heightened geopolitical fragmentation and uneven recovery trajectories. This dynamic warrants immediate concern because the central bank's fourth-quarter interventions, equivalent to approximately 2% of GDP through targeted securities acquisitions starting December 12 and amounting to an initial $40 billion in net purchases this month, are responding to decelerating growth but simultaneously fueling upward revisions in core inflation projections for 2026 to around 3%. Reflecting diminished policy credibility that could ignite wage price spirals in a labor market where the unemployment rate has risen to 4.6% in November. Situated amid escalating US-China tariff regimes that have inflated import costs and disrupted supply chains, contributing to a 4.2% contraction in bilateral trade volumes. These measures exacerbate economic consequences, such as eroded purchasing power for fixed-income investors, where real yields have turned negative, prompting capital outflows from U.S. equities estimated at significant levels, including recent single-stock outflows of $8.6 billion in a single week. Market reactions are evident in commodity surges, with gold prices climbing substantially, up over 70% year-to-date to around $4,502 per troy ounce, serving as a hedge against currency dilution, while institutional portfolios reallocate 10–15% toward non-dollar assets. Geopolitically, this liquidity expansion fuels BRICS initiatives for a multi-currency reserve system, as outlined in recent summits and reports emphasizing local currency settlements and blockchain-based payment platforms, potentially reducing dollar demand by 20% in global trade over the medium term, thereby heightening hidden risks of sudden capital flow stops that destabilize emerging markets and compel U.S. policymakers into more aggressive actions, perpetuating a cycle of diminishing returns and systemic fragility. Reflecting on historical precedents, the current trajectory of sustained money printing parallels episodes such as the 2010–2014 quantitative easing programs, where the Federal Reserve's balance sheet expansion to over $4.5 trillion aimed to counteract post-crisis stagnation, but inadvertently stoked asset bubbles and modest inflationary pressures averaging 2–3%. Or the 1970s stagflation period when loose monetary policy amid oil shocks propelled inflation to double digits, while fostering early de-dollarization sentiments among OPEC nations shifting to alternative invoicing. In those cycles, policy shortcomings, including over-reliance on liquidity without fiscal anchors or international coordination, allowed inflationary loops to entrench, with wage demands escalating in response to eroded purchasing power and reserve managers diversifying modestly into euros and gold. Yet the contemporary context is structurally more perilous owing to the amplified scale of interventions. The Fed's recent resumption of net asset purchases at $40 billion monthly follows the end of quantitative tightening in December, building on a balance sheet already exceeding $7 trillion, a magnitude surpassing the 2020 pandemic response relative to GDP, compounded by BRICS-led de-dollarization efforts that have advanced beyond rhetoric. With local currency trades reaching 96% in Russia-India bilateral flows and CIPS volumes growing 14% in the first half of 2025. This escalation differs from past eras by integrating geopolitical sanctions and tariff wars, which have depreciated the dollar by 9.72% year-to-date, accelerating alternative systems like the proposed BRICS blockchain payment platform announced in 2025 summits, rendering the global financial architecture more fragmented and vulnerable to abrupt shifts without the stabilizing alliances of the post-Bretton Woods. Odds framework. Unpacking the data and mechanisms, the inflationary risks commence with the Federal Reserve's fourth-quarter liquidity injections, initiating with $40 billion in securities purchases to manage reserves post-quantitative tightening, equivalent to 2% of GDP when annualized, which directly counters yield pressures, but transmits through expanded money supply to elevate core inflation forecasts for 2026 to 3%. As diminished credibility prompts anticipatory wage adjustments in a labor market with unemployment at 4.6% in November, fostering spirals where nominal wages rise 3–4%, but real gains erode amid price pass-throughs. Step by step, economic consequences unfold. Negative real yields on fixed-income assets, dipping below zero adjusted for 2.7% core inflation, erode purchasing power for pension funds and savers, triggering capital outflows from U.S. equities at scales, including $8.6 billion in single-stock redemptions in recent weeks, redirecting flows to alternatives like gold, which has surged over 70% to $4,502 per ounce as a dilution hedge. Capital flows interlink with de-dollarization. Institutional shifts of 10–15% toward non-dollar assets amplify as BRICS initiatives, such as the multi-currency reserve system proposed in 2025 reports and summits, reduce dollar demand in trade settlements by projected 20% medium term, facilitated by expanded CIPS and local currency packs. Debt dynamics exacerbate this, with U.S. fiscal borrowing absorbing liquidity and heightening rollover risks, while inflation erodes debt value but accelerates outflows from emerging markets holding $12 trillion in dollar-denominated liabilities. Policy logic perpetuates the cycle. Aggressive interventions to stabilize yields diminish returns, fueling geopolitical alternatives like BRICS de-dollarization paths, creating fragmented liquidity pools that increase transaction costs by 10–15% and constrain U.S. capacity in stress scenarios. Market behaviors are pricing in these intertwined risks, with equities experiencing volatility as U.S. indices reflect outflows of $8.6 billion in single stocks, underperforming amid hedging against inflationary erosions that compress earnings multiples by 5–7% in fixed-income-reliant sectors. Bonds incorporate the feedback through Treasury yields stabilizing post-purchases, but high-yield spreads widening 45 basis points quarterly, anticipating defaults as real yields go negative. Currencies respond via dollar depreciation of 9.72% year-to-date, heightening carry trade reversals that weaken allied units by 4%. Commodities surge, with gold up over 70% as institutional hedges against dilution, tying to BRICS reserve diversification. Institutional interpretations frame these as de-dollarization accelerators, reallocating 10–15% to non-dollar holdings amid CIPS growth, viewing interventions as credibility signals that preempt broader shifts before public narratives coalesce. Markets lead by processing reserve data and purchase announcements, spiking gold volatility ahead of IMF reports. Authorities grapple with profound constraints, able to calibrate purchases to $500 billion if inflation moderates, but cannot halt without risking recessionary spikes in unemployment beyond 4.6%, as aggressive easing could push inflation to 3.5%, eroding trust amid political demands for tariffs. Credibility perils are stark. Repeated printing invites premium hikes on treasuries by 50 basis points. Trade-offs involve balancing liquidity for stability against fueling BRICS alternatives, potentially costing 20% in trade dollar demand. Global spillovers differ, with the United States facing fiscal strains from outflows trimming growth to 1.7%. China leverages renminbi gains via CIPS, but risks imbalances. Russia and BRICS advance multi-currency systems, fragmenting liquidity by 12%. Europe contends with euro pressures, slowing ECB easing. Emerging markets endure sudden stops of $200 billion outflows, spiking yields and deficits to 4.5% of GDP, amplifying dollar debt mismatches. Financial systems see volatility, overloading IMF by 18%. Escalation via loops. Injections fueling 3% inflation spur wage demands at 4.6% unemployment, eroding yields and accelerating outflows of $8.6 billion weekly, boosting gold 70% and BRICS settlements by 20%. Second order, de-dollarization fragments pools, raising costs 15%. Third order, emerging destabilization forces U.S. escalations. Triggers, tariff hikes or inflation above 3%. For 2025–2026, short-term sees inflation at 3% by mid-2026, outflows persisting at $200 billion, gold stabilizing post-70% rise. Medium-term, structural de-dollarization reduces demand 20%, slowing U.S. output to 1.5%. Power shifts. U.S. wanes as BRICS grow, emerging instability from flows incites unrest. Architecture hybridizes, but transitions extend fragilities. In conclusion, persistent printing's inflationary and de-dollarization risks represent a core destabilizer, with evidence mandating vigilant strategies to avert entrenched disruptions.